Wall Street is bleeding, the Fed is under pressure, and Bitcoin quietly surging past 94K while no one's paying attention. In a week full of political whiplash and market fear, crypto is sending a very different signal, and if you zoom out, it might just be the most important one yet. From Trump's shifting stance on trade and interest rates to the record-breaking inflows into Bitcoin ETFs, and what all this means for the Fed's independence and investor behavior, there's a lot happening beneath the surface right now. Whether you're deep in the crypto world or just trying to understand why Bitcoin is rallying while the rest of the market stumbles, this is a story worth paying attention to. My name is Danilo, and today we're breaking down the macro, political, and market forces behind Bitcoin's breakout and what it could all mean for the months ahead. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Trump's relationship with the Federal Reserve has always been a little turbulent, but this past week, it took a quieter and arguably more dangerous turn. After publicly reversing course on threats to fire Fed Chair Jerome Powell, Trump made another move that caught everyone off guard. He suggested, almost casually, that he might, quote, give Powell a call and ask him to lower rates. Sounds harmless, right? But if a phone call can steer the Fed, what else can? This is where it all gets serious. The Federal Reserve is supposed to operate independently from political influence. When a sitting president, and one with a history of pressuring the Fed, floats the idea of personally nudging monetary policy, it doesn't just stir debate. It adds real uncertainty to an already fragile macro environment. And this is not the first time. Trump has criticized Powell for years, even though he was the one who appointed him in the first place. He swung from outright threats to veiled jabs, and now to offhand suggestions that carry major implications for markets. Here's why this matters, not just for Wall Street, but for everyday people. If rate policy can shift based on political pressure, then your mortgage rate, your retirement fund, even your job security are suddenly up for negotiation. That's not just volatility, that's major vulnerability. And here's the kicker. There's a Supreme Court case in motion right now that could give presidents more power to fire agency officials like Powell. That backdrop turns a throwaway comment into something way more real. The markets felt it. Bond yields pulled back. Futures traders began pricing in a higher odds of a rate cut. It's like watching the referee take tips from one of the players. Suddenly, the rules feel optional. This is exactly the kind of chaos that plays to Bitcoin's strengths. Bitcoin doesn't care who chairs the Fed. It doesn't need a rate decision or a press conference to justify its existence, and in moments like this, that neutrality becomes its biggest advantage. While institutional trust erodes at the edges slowly, then suddenly, Bitcoin offers something different. It's not just a hedge against inflation anymore, it's becoming a hedge against interference. For investors, especially those sitting on the sidelines, this week was a wake-up call. Risk isn't always about volatility. Sometimes it's about how easily a system can be bent with a single comment. And in that kind of environment, assets that aren't tied to central authorities start looking less speculative and more necessary. While headlines were focused on the political drama, Bitcoin is making a quiet move, up nearly 20% from its April low, blasting through 94K this week. And here's what makes that so interesting. It didn't happen alongside a broader market rally. Stocks have been choppy. Tech is still under pressure. Gold has lost momentum, but Bitcoin? It's been climbing almost in isolation. This is where the narrative starts to flip. For years, Bitcoin traded like a risk asset. It moved with equities, dipped on bad news, and rallied when money was cheap. But over the past 2 weeks, we've seen something completely different. Bitcoin is starting to behave less like a tech stock and more like a geopolitical indicator, reacting to fear, distrust, and capital rotation out of traditional systems. That decoupling isn't just a coincidence, it's a major signal. One of the most underappreciated forces behind this breakout is what's not moving: confidence in central institutions. While Powell faces political pressure, while the US wrestles with inflation policy and trade instability, Bitcoin is simply doing what it's built to do. No one's making phone calls to Satoshi. There's no interest rate committee. The protocol is the protocol. And this isn't just some narrative. On-chain metrics support the move. Long-term holders aren't flinching. Spot supply is drying up, and Bitcoin ETF inflows, which we'll cover next, are hitting levels we haven't seen in months. This isn't a speculative pump, it's a capital migration. For traders who've been waiting on the sidelines, this kind of price action matters. It's not just the number going up, it's how it's going up. In silence, without hype, while the rest of the market panics. That's not bullish because of FOMO, that's bullish because of structure. And if this decoupling continues, it could mark the beginning of Bitcoin's next identity shift, not just as a risk asset, but as a real-time hedge against institutional fragility. If you're wondering whether this rally is just retail chasing headlines, it's not. On April 22nd, US spot Bitcoin ETFs saw their single largest daily inflow in over 3 months, over 930 million. That's not traders with Coinbase apps. That's institutions stepping in, and hard. This kind of volume doesn't move by accident. It usually reflects a shift in macro conviction. And this week, that shift came from a growing realization that the Fed may be politically boxed in, rate policy is losing its anchor, and global investors are looking for something structurally neutral. Bitcoin, via ETFs, is becoming that access point. Let's simplify that for a second. Think of these ETFs like pipelines, and this week they started gushing. Capital is flowing into Bitcoin not because of hype, but because trust in other systems is leaking. All of these inflows also act as a self-reinforcing loop. The more capital enters, the more liquidity improves. The more liquidity improves, the more attractive Bitcoin becomes for even bigger players. Pensions, funds, treasuries. Add in the ETF wrapper and suddenly, allocating to Bitcoin doesn't require cold storage or private keys. It just requires conviction. It's worth pausing here. 930 million in a single day is more than some of these ETFs saw in entire months earlier this year. And it happened when the markets were distracted by politics. That's a narrative shift in real time. Bitcoin didn't just have a strong week. It became, again, a macro asset, just one with fewer gatekeepers. This is why we keep seeing this slow, quiet uptick in long-term positioning. It's not retail mania. It's structured capital, the kind that doesn't blink on dips, and the kind that tends to show up early and not late. Behind the headlines and hot takes, there's a deeper fight brewing, one that could reshape how the Federal Reserve operates and who really pulls the strings. Trump might say he has, quote, no intention of firing Jerome Powell, but there's a legal pathway forming quietly that could make it possible anyway. And if that door opens, the implications for markets and for Bitcoin are massive. Here's what's happening. Right now, the Supreme Court is reviewing a case that could give presidents broader powers to fight the heads of independent federal agencies. That includes Powell. Technically, Fed governors can only be removed, quote, for cause, a term that's never been clearly defined. But if this precedent gets overturned, it could give the White House far more control over monetary policy, whether through direct replacements or indirect pressure. Let's be real. If this weren't happening inside a central bank, we'd call it political overreach. It's not just about who sets the rates. It's about whether the institution making those decisions can be trusted to act independently at all. That may sound like a footnote, but it isn't. The Fed's independence is what gives the market confidence that policy decisions are based on data and not politics. If that buffer erodes, every rate decision, every inflation target, every bond purchase could come under a different kind of scrutiny. Not what's best for the economy, but what's best for the next election. And that's where Bitcoin re-enters the conversation, because it's not just about how high or low rates go, it's about who controls the system. Bitcoin has no chairman, no election cycle, no closed-door decisions. The protocol is public, the issuance is fixed, and the network doesn't respond to headlines. That's starting to look less like a novelty and more like a necessary design choice. Just think about the stakes. If the Fed is perceived as a tool of the executive branch, especially during an election year, we're not just talking about market volatility. We're talking about a crisis of trust. And in that kind of environment, alternative monetary systems don't just gain attention, they gain more legitimacy. That's why Bitcoin's reaction to this political tension isn't just speculative, it's rational. It's a real calibration of what counts as stable, what counts as credible, and what investors are willing to trust when the foundations start to shake. One of the louder predictions floating around right now is a $138,000 Bitcoin target within the next 90 days. It sounds kind of extreme, until you look at where it's coming from. The call is based on a model by economist Timothy Peterson, who's tracked Bitcoin's performance after spikes in high-yield interest rates. According to his data, when those yields push past 8%, like they just did, Bitcoin tends to rally in the months that follow. Since 2010, it's happened 38 times. In 71% of those cases, Bitcoin posted positive returns 3 months later, with a median gain of around 31%. This isn't just a fun stat for traders, it's a window into how Bitcoin behaves under macro stress. When credit markets tighten and liquidity dries up, most assets suffer. But Peterson's thesis is that Bitcoin, which lives outside the traditional financial plumbing, often becomes more appealing. especially when institutions start looking for asymmetric upside in an environment that feels increasingly rigged or restricted. Now, let's be clear for a second. Correlation isn't causation. Just because it's happened before doesn't mean it's happening again. And 138K is still on the high end of the historical range. Peterson's model suggests a potential window between 75K and 138K, depending on how the next few months play out. But even if we land somewhere in the middle, it would mark a major shift in market structure, especially if it happens without a full-on retail frenzy. That's one of the most interesting parts of this setup. It's not being driven by TikTok traders or meme coin pumps. This time, the volume is coming from ETFs, long-term holders, and institutional accumulation. It's quieter, more measured, and honestly more believable. If we do see another leg up, it may not look anything like 2021. It could be slower, more strategic, and built on conviction and not the usual chaos. So, is 138K guaranteed? No. But is it within the realm of possibility, especially in a macro environment this uncertain? More than most people realize. And in a market driven by liquidity, narrative, and crowd behavior, sometimes all it takes is the right setup and a bit of momentum. Right now, we've got both. This week wasn't just about a price breakout. It was about what the breakout represents. The current president is pressuring the Fed. The line between politics and monetary policy is starting to blur. And for the first time in a while, Bitcoin is behaving like a macro asset, not a speculative flyer, but in response to a system under strain. We saw record ETF inflows, a surge in institutional demand, and price action that moves independently of traditional markets. That kind of decoupling doesn't happen randomly. It happens when trust starts to shift, away from central banks, away from politicians, and towards something people believe can't be manipulated. Whether or not Bitcoin hits 138K in the next 90 days isn't really the point. What matters is why that prediction is even being taken seriously. It's a reflection of the moment we're in, one where even the idea of Fed independence feels uncertain, and where more investors are looking for assets that exist outside the uncertainty. So the real takeaway isn't just that Bitcoin's up, it's that the story driving it is changing, and if that shift continues, it might not just be a rally. It might be the beginning of something much bigger. If you found this breakdown helpful, make sure to drop a like, subscribe, and hit the bell so you don't miss the next one. And I'm curious, do you think Trump will actually fire Powell during his second term? And how high do you see Bitcoin going this cycle? Drop your take in the comments. I'll be reading them all. Thanks for watching, and I'll see you in the next one.